Hi everybody, this week we have three interesting webinars lined up for you. First one is on the topic real estate versus equities. So in this webinar we'll be discussing about the pros and cons of the real estate market and also how you can allocate between real estate and equities. Second one is on good investing at bad times. So here we'll be discussing about investment strategies which can weather all market conditions. Third one is on will the US elections impact the stock market? So if you are someone who is confused on how the markets will react from here, do tune into this webinar. All the registration links are given below in the description. Do check it out. Hope to see you all there. Thanks.
Hi everyone, welcome to this new series of Talking Straight with Shyam Sekhar. In this session, we will delve into the aspects of how an investor should look at a management quality when he is analyzing a business. Hi sir. Sir, you have been in the markets for close to last 3 decades, and you have seen how Indian markets are evolved over the last 3 decades. So, in that context, we will devolve in a topic on management quality. So, how important is a management quality for a long-term success of a company?
It's very, very important. There have been managements which owned great businesses, but their intention was only to grab the business away from the public shareholders. There have been managements which battled with mediocre businesses for decades, but suddenly, when there was some policy change, those managements really started shining. You take the EPR regulations for rubber. There have been many managements which waited for 20 years for this to happen.
Yes.
Right? But they are very good managements. I won't name the companies, but you know. So when this change happens, good management will start shining. But imagine that management wanted to use the bad days and delist and become public, private. Then the intention will be different. Then they won't be good for us. A management should respect the shareholders, it should want the participation of shareholders, it should respect the rights of the shareholders, and it should respect good governance and transparency. So, if you have such a management, even in a business that is not seeing good times, you can stay with them. Whereas, in bad times, if you are with the management whose intention is not good, your experience is going to be very different. That is the point I am trying to tell you.
Okay, sir. So on that lines, have you developed any framework to assess management quality or any key metrics that an investor should watch for and in a management in that if he watches this 3-4 metrics, then he can arrive at a conclusion that this management is good to travel along over a 3 to 5 years kind of time period.
3-4 metrics you are asking?
Yes, sir.
One simple metric is what is the payout? A payout policy is a very, very simple metric for any management. And in fact, you see the most successful managements in South, they have had a very clear payout policies. You have never lost money with them because their commitment to the shareholder is so strong, so visible, and so proven. So later, when they start doing well, shareholders are willing to give higher valuation to such managements. Whereas some managements will be very oily and they won't commit to payout policy. Right? Payout is one. Then the kind of management discussion which is in the annual report, that's a very simple, it's not a data point, I mean it's not a statistic, but it's a evidence, right? That is another metric I would say. Quality of management discussion is very, very important. Third is capital allocation. These are three very simple metrics for us. If management doesn't need money, they should return it to shareholder or improve shareholder value. If they go and buy an aeroplane, it shows the capital allocation is bad. Or if they go and do some unrelated diversification. In fact, many companies going and starting equity portfolios itself, in my opinion, is a sign which you should be careful about. It's not a good sign always.
So within the management, So the market, they segregate the companies in terms of family owned and promoter run management and professional run management. I've just taken the last 10 years of BSc 500 data. So there around 350 companies or family owned businesses where the promoter stake is upwards of 25%. So these 350 odd companies have outperformed the professional run companies, both in terms of fundamental metrics like you mentioned in terms of free cash flow generation. So the free cash flow generation or growth over the last 10 years for the family owned companies has been 10% higher than the professional run companies. The past data looks like that. So going forward, an investor should solely focus on family owned companies while analyzing when he's analyzing investment opportunity, or will we go in terms of developed countries where the professionals are running the business?
See, there are good things in both forms of management. In a family run business, the commitment of the family, when it is higher, can be hugely positive. For example, you take even a good industrial family of the South, any good industrial family of the South. Is the next generation ready to show the same commitment as the previous generation? And if you are having 3 generations, you should compare 1, 2 and 3. Are you seeing greater commitment with every new generation? If you are seeing that, then you will see the results. For example, in the Murugappa group, you have seen that in certain companies where that commitment was highly demonstrated. In TVS, you are seeing that today in TVS Motor itself. Right? Yes. I am sure you are seeing it in several other companies. There are many managements who have raised their children in such a way that the succession will be a superior succession than their own succession. Now, if a management has that vision, being with them is hugely positive, and we know many of our good friends in the investment circle, value investors, have stuck to those managements for decades to great success. Now, professional management is the other issue. Now, professional management is answerable to the board, and board is accountable to the shareholders. That is the equation. Now, in the case of a family-run company, the family management feels directly accountable to the shareholders. There is no intermediary in this. The board merely oversees the functioning under the family, whether the governance is at the right level. So, the independent director is supposed to look at the working of the family. The family doesn't report to the independent director. It doesn't work like that. Right? That's a big difference between these two. Right? So, in a professionally managed company, the board can at times go overboard. Board can go overboard with professionals, or professionals can go overboard, and the board may sometimes not be alert enough, and the board can wake up a little late. So you can see aggressive boards, you can see docile boards. You can see aggressive professional managements, and you can see very subservient professional managements. Now, how these 4 categories combine can have a bearing on professionally managed firms. Sometimes professionals can really take companies down the garden path, and then a new guy has to come in and correct it. You saw it in the best of tech companies. You take the Vishal Sikka episode in Infosys. He was a professional, hugely respected, but somehow what he did not gel with what Infosys needed. You take the recent episode in Cognizant of Brian Humphreys. It didn't work well with Cognizant. The board suddenly fired him. In both instances, board removed. You take Tata Sons, where you had Cyrus Mistry. So, I have given you 3 instances where the appointment is called professional. Right?
Yes.
But the board somehow could not get what it wanted from the professional.
Got it, sir.
So, it's very important that the board does its duty in both cases and ensures the professional delivers. That in a professionally run company, the board has to ensure the professional delivers, and it has to win the professionals, and it has to make the professional win. Both professional should completely trust the board, board should trust the professional, and the trust should be based on well laid out principles of governance, not I do this for you, you this for me. It's not a quid pro quo driven arrangement, right? So this is very, very critical. Now, if you take the professionally run managements and the boards, I am going to give you a few examples. You take ITC, the professionally run company in India, there is no promoter. Now, the professional management resisted many things which were in the shareholder interest. Raising dividend was a difficult thing in ITC. It came very late. Correct? It came when the market cap collapsed. Logically, it should have happened much earlier. Right?
Yes.
The board has not managed to convince ITC to demerge businesses and create shareholder value for a long time. Even the demerger you are seeing now in hotels, it's not a simple straightforward demerger, it's a convoluted demerger where ITC holds shares. So these are cases in which there is a lot of things that could be better. We take Larsen & Toubro, a completely professionally run company, one of the greatest professionally run companies India has built. Right? It's a company that is so important to our country. Now, Larsen & Toubro has a financial services business which has done nothing for that company. The professional board never questioned why Larsen & Toubro should get into financial services. The professional board still is not asking Larsen & Toubro to leave that business. Tremendous shareholder value will be created if you don't append the financial services business to the L&T balance sheet. Suppose you remove it and see, the L&T balance sheet will be pristine. The board has not got the best out of the professionals. Whether the professionals got the best out of the board is not the issue here. The board had the duty in both instances to get the best outcome for the shareholders. It's taking time, it's not happening easily. That's the point I'm trying to tell you. Professionals have the capacity to manage boards. Right? Now, later, once the professional leaves, is anyone going to blame that Mr. X was wrong? So, accountability is not high in a professional system, whereas a family member can never escape the blame. That's the point I am trying to tell you. They always have to bear the cross. I hope I have given a clear, example and thing for you to understand the difference between professional and family. I think that wherever there is accountability, you should give respect. You should not say I will go only to family or only to professional. Where there is a very clear line of accountability, you can place trust.
Got it, sir. And just continuing on the last question. So there are companies which are part of this diversified conglomerates, and we are seeing that within the conglomerates, one company will be doing exorbitantly good. They will be generating free cash flow, while the group company, which will be into asset heavy business, and there the promoter may need cash. We have seen some instances where the promoter will be taking cash from this free cash flow company and then providing intercorporate deposits to another company. And as an investor, how should one go about investing in this free cash flow generating companies? So whether it should be conservative and ignore it, or you should look at the business strength and then continue invest in that company.
See, first we have to see the nature of the transaction. Is it arm's length? Is it at the right interest rate? Is it invest in a project which has got a structural weakness? Or is it in a good project which will definitely return capital in 4 years or 5 years, not longer than that? Right? If that is the case, then does this company also get some additional benefits for lending that money? Does it own shares in that company? There are a lot of ifs. But generally, I prefer these kind of transactions not to happen. The promoter can dividend out money and then lend it from his own personal balance sheet. We have no problem with that. If he doesn't want to pay tax and he wants to do it through this balance sheet, it is a problem. Let me tell you that historically, from the time I came to market, this intercorporate movement of capital often was irreversible. Money never came back. Quietly they will do a balance sheet item and write it off and go. No one will know. They will do the adjustments very, very coolly. Lots of money has been siphoned out of companies by these kind of actions. Today, I think the accounting standards and disclosures are much better than it was, let's say 30 years ago. So, we are somewhat in a better place. But ideally, if you don't have transaction like these, you are in the best place. That is what I would say. I would prefer this not to happen. And if it happens, and it happens by exception, I want to be sure that there is a proper lien and there is a proper method to recover that capital, and to also trace the capital when it is in the other company's hands. Like naming, mentioning in the notes, calling it a related party transaction, having a charge on assets, all that should be there.
Just continue on this South-based companies. The general perception is that South-based companies are conservative in terms of entering new technology or new businesses, and in terms of allocating capital. So, just your view on this perception.
I think if you see the entire tech industry, South has been definitely at the forefront. If you see the number of companies that are in Bangalore which are becoming unicorns and stuff like that, which take very high risk, South is definitely at the forefront in all these things. But traditional family-run companies have not shown risk appetite that nation building needs. That has been the weakness of the South. For example, all your top business groups in the South had the balance sheet to do solar. What a clutch of companies in Gujarat have done in solar, all the South Indian companies could have done, not even one did. That's one obvious thing. If you see all new emerging technologies that require capital, the South has not shown even a tendency to explore the opportunity actually. If you take the new age businesses, family businesses have got left behind completely in that. I think the risk aversion is definitely of a high order. Even if you take the companies which have done well, groups which have done well, they have not started a company ground up. They have acquired some other company and made it more efficient and created valuation. Which means they have not really invested money, Let's say you put 500 crore and create 50,000 crore market cap, right? It does not add to the economy. Understand that. So, industrial groups can become rich, but they don't contribute to the economy. Whereas, if you take a Reliance or a Tata or a Adani or Birla or Goenkas, they've all taken these risks. They have participated very actively in what is good for the economic development of the country. I think Southern entrepreneurs have much to prove, and we can criticize them all evening. I mean, it's not been a good thing, I would say that.
So, in part 1, we have discussed mostly on the family-owned businesses and professional and companies, and then a part of government-owned companies. So, in the part 2, we will discuss companies which are promoted by government companies, multinationals, and first-generation entrepreneurs. So, see you on the other side.